Hey, good afternoon, everyone. Welcome back to the Blockchain Advisor podcast channel. I am Bill Ulivari, and today we are joined by Vincent Deluard. He's the Director of Global Macro Strategy at StoneX. I invited Vincent a week or two ago after watching him on the Real Vision channel interview with Ash Bennington talking about the yen carry trade. And for those of you that have followed my newsletters and some of our podcast specials, we've talked about the Raoul Pal Real Vision and his "don't screw this up, don't blink this up" hashtag in terms of crypto and the banana zone that we're about to enter. So we're going to have a quick conversation with Vincent. Thank you so much for joining us, Vincent. I really appreciate your time today.
It's a pleasure to be here.
Thanks. All right, so can you, again, I'm sure everybody who interviews you starts out with this conversation can you give us a quick overview, explain it like I'm five. What is the yen carry trade in terms of borrowing cheap and lending expensive?
Well, I mean, the carry trade really is something as old as markets themselves. I mean, it's basically buying something where it's cheap and selling it where it's expensive. That's what makes a market.
And now they're doing it with currencies instead of grains and steel and other products. We lost you.
So the floods of the Nile and selling raw material profit, and you would across the sea, and that was the kind of initial carry trade. Now, of course, we live in a much more financial economy. So now instead of moving wheat, which we still do, by the way, but a lot of the carry trade has moved to financial assets, including currencies. And because we have different economies that are different part of the cycle, interest rate policies can be vastly different. And for the longest time, Japan was the exception, right? Japan had no inflation, had very little growth, and the Bank of Japan kept rate at 0 or even slightly below it, did massive quantitative easing, and it was very easy to borrow money in Japan and to invest in jurisdiction that offered a higher rate of return. Another thing that helped with the Japanese carry trade is that the Japanese population has a very high savings rate. So you had a lot of people of money and very few things to do with. Mr. Watanabe, the famous kind of Japanese saver, would buy options on Nvidia or invest in the Mexican peso, do things that seems a bit crazy for a conservative investor, but these things are quite common in Japan. And because Japan is the third largest economy in the world, what Japan does matters a lot for the rest of the world. So I would say the golden age of the Japanese carry trade really started with Abenomics in 2015 when we had these very aggressive policy mix, weak yen, low interest rate, large QE that kind of gave the all clear signal to investors that they could engage in these trades and that policy would not blow up in their face. And I suspect the summer of 2024 represents the end of that era.
Interesting. So you were saying on your interview with Ash Bennington that Japan still produces a lot of things. It's still a very big part of the global economy. I got to be honest with you. On the American side, we have forgotten about Japan. It was big in the 80s, 1989, early 90s, but China and some Asia had really taken over the conversation. So, but then looking back, I know that just in the last few months, on our mainstream media, they were just broadcasting the new highs of the Japanese yen, the Nikkei market, and just how fabulous they were doing. And it was almost like a magician who was trying to distract what was happening here in the United States. But perhaps their markets were making all new highs, but their yen was actually making kind of all new lows, right? So that disparity between the frog in the pot kind of syndrome, which I think you're implying may be happening across the pond in France and Germany going forward.
Yeah, I mean, I think that was the idea with the weekend policies that Japan has this very low growth economy, actually has shrinking population. So in most, well, when you do our discounted cash flow models in the US, we assume okay, perpetual growth of like 4 or 5%, whatever, right? In Japan, you actually have to pin in a negative number. So as a result of the secular shrinkage of the US economy, the Japanese economy, a lot of Japanese business have gone overseas. So initially it was Southeast Asia, Thailand, Indonesia, Vietnam. A lot of Japanese capital went there when looking for growth in this higher jurisdiction. So as a result, the Nikkei index, the Japanese stock index, is dominated by these high quality exporters, quite often in industrial areas. Obviously, we all know about the Japanese cars, but you had shipbuilding, you had steel, high precision electronics, machinery. It's a very sophisticated, advanced economy. And for these exporters, obviously, a weak currency is great because most of your costs are in yen, and most of your revenues are. I mean, if you're going to trade with, sometimes you can trade in yen with Asia, but most of the time it's going to be in dollar, right? The dollar is still used for 70% of global trade. So you get your revenues go up, your costs go down, your margins go up. That's one of the reasons why the Nikkei has done so well. It's actually outperformed the S&P 500 on not adjusting for the currency, which is very rare, right? Because the S&P 500 has outperformed most international assets. Japan was the only one that was keeping up, in large part because the currency was depreciating against it. But if you just look at local currency return, it was matching. But if you can have too much of a good thing, right? I think we got to the point where the yen was so weak when it got to like 160 against the dollar, where even for these big industrial exporters, that was becoming a problem because obviously they need to buy, steel, iron ore, platinum, whatever, copper. And when the yen was losing 10% a month on top of the volatility that we've seen in the metals complex, I mean, that made it almost impossible for them to manage this risk. So that was one issue on the corporate side. And then there was a secondary issue, which was on the inflation side. Inflation started to pick up in Japan. I mean, Japan had no inflation since the late 80s, basically. It was a poster child for deflation. And every spring they have this wage negotiations that kind of sets the tone for inflation. And for the last couple of years, it's been 5-6% up. It was time for the Bank of Japan to change course. This is what they did in late July, early August, where they started raising rates. I mean, I think it was just 15 basis points, but if you've been at zero for so long, even a tiny move really feels like a lot.
Right.
And more importantly, they changed their balance sheet policy. I mean, because they've been doing QE for so many decades, the Bank of Japan owns more than 100% of GDP in assets. Actually, most Japanese debt is now held on the Bank of Japan balance sheet. And they said, hey, we're not going to reinvest as much as we thought we would. So that really pushed long bonds out. And I think more importantly, it's more than the rate differential. It's really the signaling. I think for 10 years, basically, the Bank of Japan and Mr. Finance told you, hey, you can do this, borrow in our currency and put the money abroad. And they were signaling that this era is over. And when you have a very crowded trade, it's the traditional metaphor, the crowded theater. Someone screams fire, everybody rushes for the door at the same time, and you saw the yen rally by 10% overnight. The Nikkei was down by 14% on that Monday, the yen carry trade it may not be over, right? I mean, people always find ways to borrow money, but I suspect it's going to move, and my idea is that it's going to move to Europe.
Interesting. And so you had said it in an interview with Ash that these things can sometimes, like these shocks only last maybe 12 or 18 months. I think that's what I heard you say. But if this has been going on for 15 years, how does the bank unwind this? How do hedge funds and insurance companies, like, how slowly do they have to move what appears to be a very, very big ship? And here on the screen, I have a long-term chart of the US dollar versus yen carry trade. And, it's last 4 or 5 years, it has been kind of sidewaysy, between let's see, what is it? 140. I had to put my reading glasses on, somewhere between, 138, 139 up to the high 160s. But it does seem to be that we're about done here, and that we could potentially see a sell-off into, boy, if we go back to this time period of 2015, 2016 to 2018, like you had mentioned, Vincent, this could be a huge shift in how the US dollar yen trade is going to look. And I just, if it's as big as you say it is, how long does it take to turn a ship like this?
Yeah, one thing I would mention on the chart, I think you're looking just at the price return of
Yes.
the yen versus the dollar. The carry trade, there's also the carry element of it, right? When you invest in currencies, you have the spot price, and then you have the interest rate differential. So
Right.
if you borrow in a currency with zero rate or even negative rates, you get paid on the borrowing side if the rates are negative, and then you get whatever interest rate on the currency that you're investing. So in the US, there's a big difference, right? The US, I mean, we're recording pre-Fed, so we still have 5 from 25 interest rate. That's probably going to drop, but you were getting 5% of carry with the dollar. Now the real juicy part was if you were going to do it with the Mexican peso or the Brazilian real, where you get these 11, 12% overnight rate. I mean, even if the currency doesn't move, you're getting 1% a month from borrowing in Japanese yen and investing in the real and the peso. So I think when people refer to the carry trade, it was mostly towards emerging markets. I mean, in this case, maybe it was a bit, I think the NASDAQ ended up getting a lot of that Japanese money, but typically when people talk about the carry trade, they refer to selling a cheap currency, a lower interest rate currency, and investing in a higher carry currency, typically LATAM, sometimes Australia, New Zealand, not necessarily the dollar. And if we look at return, you really want to look at total return. Per your question, how long does it last? Historically, it's a pretty brutal event that clears up after a month or so because it's positioning, right? So, anything with leverage, eventually you run out of longs, people have to cover. Now, in this case, I suspect it could last a lot longer because, as you mentioned, this has been going on for 10 years. So I don't think we've seen the end of it. I mean, Japanese households have tremendous foreign assets. And if they start to repatriate, this could indeed last for about a year, I would guess.
And so here in America, we're on the everybody's on pins and needles about what Jerome Powell, the head of the Federal Reserve, is going to do with interest rates. And I haven't checked my screen in the last few hours. So some opine that it'll be 25 basis points, other 50. But here again, we are stuck with this 5.25, 5.35 SOFR rate, the secured overnight funding rate. And yet the 10-year U.S. Treasuries are about 3.62 or so, roughly. So I'm just wondering, like, how slowly is the Fed going to reduce rates, or do they feel a sense of urgency on the side of Japan? Like they don't want a shock to the system. Maybe they would go slower than. I mean, and is the Fed being influenced more by domestic issues, unemployment and inflation, or do you think that someone's texting Federal Reserve from the Bank of Japan saying, "Hey, don't do too much too soon"? Because you're going to throw the world into a turmoil and cause a recession, and right, because it is about a leverage unwinding.
Yeah. So if they were to cut faster, that would indeed accelerate this unwind of the carry trade, right? Because you would shrink the interest rate gap with Japan. So you would make the dollar less attractive for Japanese investor. You would tell them, hey, you can send some more money back home. So that would add indeed to this bout of volatility that we saw in the summer. Per your second question, I do not think the Fed really thinks all that hard about the carry trade or the yen. Target for the dollar. We don't do exchange rate. I think that is especially true now. If I were to kind of read the minds of the Fed, my guess is their consideration are a mix of perhaps legitimate concerns about the labor market. I don't buy them, but maybe there's a section of the Fed, some governors that really think the economy is slowing and that they need to ease and that inflation is gone and that they've been too restrictive for too long. What we would call CYA, cover your
Yes.
rear end, and the fear of being embarrassed. Bureaucrats. Looks bad. And I think the Fed has determined that would make them look really, really bad.
Mm-hmm.
Okay.
I think I lost you.
That these cuts are not needed.
Yeah, I think Vincent, I'm losing you. You're one of our internet connections is a little bit spotty. You've been cutting out a little bit. I think the last thing you had mentioned was how you didn't think that the Fed was going to cut rates so quickly because it would be embarrassing. Here we go.
Yeah, so I'm not sure that the Fed really thinks all that much about the Japanese yen when it sets monetary policy. I think the biggest fear right now is to look like fools if the economy does slow and we get into a recession, and then they get accused of not having cut fast enough. I mean, they already blew up on the inflation, right? They didn't hike. They waited until inflation was at like
It's
7,
transitory.
8%. Yes, exactly. So they're trying to correct. Typically, policy always overcorrects, right? You make one mistake and then you make the other mistake after that. So they were too slow to act when inflation picked up. Now they have the view that inflation has fallen and that the problem is the unemployment rate, and they want to be proactive and they want to cut. Even though the data is very mixed, I would actually argue there's a pretty good chance that the economy reaccelerates.
Mm-hmm.
But they view that the risk of staying restrictive in their word for too long exceeds the risk of doing the other. Basically, they'll get into more trouble from politicians if they don't cut right now.
Do you remember ever a time in the United States where we truly had a soft landing? I mean, every experience that I remember in this business was there was blood in the streets, the market was getting killed, unemployment was high, politicians were screaming, and that's when Warren Buffett was waiting with his pile of cash to buy Bank of America and and other companies. Do you really think that they're going to be able to pull off quote unquote a soft landing, or do you think they're going to wait for something to break where they'll be the savior of the economy once again?
I mean, there has been, if we define soft landing, which were not followed by recession, that has happened. That happened in 1995, as the famous one, which earned Greenspan the moniker of the maestro. And then again, 1998, following the collapse of LTCM and the East Asian crisis, we had a lot of market volatility. Now, of course, it was clear that there was no risk of recession in the US, right? But because all the Asian currencies had collapsed and the price of oil had collapsed, suddenly inflation fell, gave the Fed some room to cut. Now, you could argue that these cuts then inflated the tech bubble and the internet bubble and caused them much more pain later. I would actually believe that's true. But at the time, it seemed like, Greenspan had that pull on the soft landing camp. I'm in the no landing camp. I mean, you can check the Atlanta Fed publishes GDP now, an estimate of where GDP is at in the current quarter. We're at 3% today. We've been at 3% for a year, 3% real growth. Now you have inflation of about 3%, and it's probably undercounting because a lot of that insurance now is happening in insurance, which is not getting captured in CPI. So we have 6% nominal growth. And we're cutting, and the unemployment rate is still, 4% is considered full employment. It would have been considered full employment 4 years ago.
Right.
And that's after this historical immigration wave, which is probably ebbing anyway. So I think that, I don't see, honestly, any reason for the economy to slow at this point, to land. So it might be a no landing. Last year, we're going through these fears every 6 months, because you have to understand that most people on Wall Street borrow money. So when you borrow money, you don't like to pay, okay? Because you don't, that's human nature, you like more money. So if you give more money to people, you have less money for yourself. So there is this inherent, the Fed needs to cut bias from the bank, from the private equity. Anybody who takes on debt wants the Fed to cut. So they will come up with narratives to justify, if you don't cut, this horrible thing is going to happen. Now, that was already happening last year. Last year had made the forecast that we're going to have a trampoline landing, meaning that the economy would actually reaccelerate. And remember, 2022, everybody, I think Bloomberg had an article saying that they had 100% probability of recession in 2023. By the way, note for future reference, never forecast anything with 100%. I mean, because
Sure. You got to fade that.
yeah, leave yourself a little wiggle room. You know, you're not that good.
Yeah.
So, and you're going to look like an idiot. So at the time, I had forecasted with a 99% chance of a trampoline landing, that the economy would actually reaccelerate in late 2023, which is what it did. So I remain the same, maybe not trampoline, but again, we are a trend, 3% growth. And yeah, we'll get a little bit of stimulus, not a lot from Fed cuts, but still we'll get lower rates. We have very low spreads. We have fiscal policy that's about to get easier. The weaker dollar is a little bit of a help. So weaker oil prices are quite weak. So we really have this kind of perfect combo for the economy to keep growing. And keep in mind, growth is a natural state of the economy. I think there is this tendency in the macro community of, you know, calling for recessions, because you become the hero once you call for the recession. Then you can point out and you can build your entire career on that one call. I'm not going to name names, but you know, some people call the '08 recession, and I've been calling a recession every year ever since, and I still living off that. So there is this, you sound smarter when you're a bear, you know, when you're a bull, you kind of, not a bull, but you say, yeah, I think the economy is going to be fine. That doesn't get you headline. That doesn't get you booked on CNBC. So I think we have this bias where we kind of want to predict, at least it sells. The industry wants rate cuts, and then, you know, it makes for good headlines. So we have this excessive bearishness on the economy. And it seems to me that the mind virus has gone into the Fed's head.
Interesting. Yeah, I used to say that the market is rigged to go up because everything that's growth and inflation is kind of embedded in the pricing power for companies, and it just seemed like that was a good tagline, right, from this side. So, Vincent, let me ask you this question: can retail investors take advantage of a yen carry trade or a carry trade themselves in their 401ks or in their IRAs that you're aware of, that isn't overly speculative, that could still give, you know, maybe small business owners have an account set up at Fidelity or Schwab or whoever, and it's a business account. Can they just lean a little bit? We're talking small numbers toward a trade like this, where they could protect themselves in whatever type of fashion the yen carry trade may look like going for a carry trade.
I mean, if you have a brokerage account, like I think you can take currency position, right? I mean, if you have an interactive brokerage account, you can probably do a short yen, long peso position with, you don't need to have a bank account in Japan to do that. Now, I would not recommend doing that with a yen for the reason we discussed. I believe that yen carry trade is probably over, but certainly you can take a position. I believe the euro is going to be the next funding currency. You can be long the Mexican peso, the Brazilian real against the euro, and earn that spread. Absolutely, sure. Even as a retail investor. Yes.
So one of my favorite quotes of 2024 was, again, when you were on Real Vision, and you said, I didn't catch every single word, but I have the majority of your statement about what's going on in France, right? And we too don't really have a government in a way because of the whole situation with the Democratic National Convention and President Biden kind of stepping aside, and the Kamala being automatically nominated. But you said, Vincent, about France, we haven't had a government since June, and we are not closer to having a government. And if we don't have a government, we cannot have a budget. And civil servants don't get paid. Now, if you think that French civil servants have the tendency to get unruly and decapitate people when they're pissed, just imagine when they're pissed and not getting paid. Literally the best line of all 2024. Again, Americans, we live in a where many of us are just narcissistic in the news media. Like, we don't see what's going on overseas, and we're not really paying attention to the riots and to the protests overseas. We're focused on really, I don't know, we just don't have a global perspective when it comes to news. Like, maybe we get some BBC news, you know, it's financial news media that comes free streamed. Like, help us, you know, U.S. investors get really an appreciation of what's going on overseas in France or in Germany, because you had mentioned the Volkswagen not being willing to continue the social contract that had happened after World War II with their employees. I think that's a big deal. I'm sharing that podcast with my friends that are in Germany, in Italy, and Spain, saying, "Hey, you guys are about to get a rude awakening here, where the social contract goes from full unemployment all the time with recessions to, okay, we're going to fire 15 or 20% of our workforce and we're going to buy back shares, right? We're going to put the shareholder first ahead of our employees." So just tell me a little bit more about what you see happening in overseas, like right now, that we should be paying attention to, and we're not, because we're focused on this stupid election business ourselves.
Yeah, I think we have a really a very deep social crisis in Europe, and it is essentially the end of that social contract that was passed after World War II, where, effectively Europe lost World War II. It didn't matter. I mean, France was technically on the winning side on the very back end, but it didn't matter. By the end of the day, by the end of the war, we'd lost our empire, we'd lost our hegemony to the US, and at the time the Soviet Union. And the contract that was passed between the US hegemon and its protectorates, France, Germany, Italy, is like, okay, you stop this great power game. You've been at it for too long and you've done horrible things. We're in charge now. But in exchange, you can have relative prosperity. You'll more or less catch up to our standard of living. You won't have to maintain a big army, and you can have a good welfare state. And most Europeans were actually okay. It's like, yeah, sure. We don't need to, conquer Africa or deal with like expensive wars. Let the Americans do it.
Sure.
So the Germans did what the Germans do. They built really good cars, and that provided employment, and they built a wonderful economy. The French were a little bit less good at the economy. But we still had we built a very generous welfare state. And this is what's unraveling. Obviously, since even before Trump, really, the Americans are just not interested anymore in
Right.
dealing with the Europeans. You shifted your focus to Asia, competition with China. You don't really want to maintain all that, architecture in Europe. And then on top of that, you throw in the demographic changes, which impact everybody, but Europe especially more so. We are more geriatric than the US, right? We have everything that we built on the assumption that we'd have, 3 or 4 people working per retiree. I mean, now it's looking 1-to-1. So obviously you would have to either, cut everything by 75% or increase taxes. And these are things that are not possible. So you have this funding crisis of the welfare model. And then you have the Americans telling you, hey, we're not really interested in defending you. And by the way, Russia is aggressive again, and we're going to blow up your pipeline. So yeah, it's a big problem. It's a big problem, and it's one that doesn't have an easy solution. So in Germany, it's mostly an economic problem at this point, where the industrial production has been shrinking dramatically since the war. They used to rely on this cheap gas from Russia, which they cannot get. Instead, they have to pay a lot of money to import liquefied natural gas from Qatar and the US, and that makes their industry a lot less competitive. They made things worse by ending nuclear and investing in wind power that hasn't quite worked out. So the German economic model is in a slump. They're facing the competition from the Chinese cars. So yeah, Germany is very weak. In France, it's more of a political crisis. But for the same reason, really, the economy is not performing as well as we thought it was. Basically, by May, the French finance minister realized the tax money was not coming in. The deficit was going to blow up. Macron, the French president, came up with a crazy plan to dissolve the National Assembly, call for election. It was a big chaos, big mess. I'm going to skip on the stages, but basically the point is no one wants to govern France. Macron's like, I'm not owning this. You guys figure it out. And then the left party who kind of won the elections, like, oh no, I have to govern now? I don't want to do that. And every party is kind of doing that at the same time. So finally, we agreed on the name of one guy, a prime minister, but we still don't have a government. And we still have the problem that, yes, we're going to have a bigger deficit. And in Europe, we have all these rules about the deficit you're allowed to run. So my point is you have the German economy, which is a powerhouse in Europe, in recession and has been in recession for 2 years. And then you have the political leader of Europe, which is France, traditionally, which doesn't even have a government. So you can see how the Eurozone is in a big mess. And that's one of the reasons why I think we will see much more cuts in Europe. And the only way we'll get out of it is basically trashing the currency, right? I mean, if you
Mhm.
you know, if you can't agree on anything, if your
Destroy
economy
the
is weak,
currency.
yeah, exactly. The path of least resistance is okay. We know we're going to cut rates to zero. We're going to get the euro 4, and hopefully something will come up, right? Our exports are going to pick up, or so that's why I think the Europe is in some ways in the same position that Japan was 10, 15 years ago, where you could see this prolonged period of weakness in the euro. And one last thought on this. Traditionally in Europe, you have these two camps when it comes to monetary policy and currency. You have the South and the Mediterranean countries that are very indebted, typically grow not very fast. So they typically want low rates and a weak currency. So that's your Spain, your Italy, your Portugal, your Greece, right? And the North or the core, Germany, sometimes France is in there. The Netherlands, Finland, typically want higher rates and a stronger currency. What's happened in that now the crisis, 10 years ago, the crisis used to be in the periphery. So the core could
Yeah.
just tell them, okay, you fall in line and you do what we want you to do.
We'll take care of you.
Now the crisis is in the core. So you don't have this kind of discipline structure, and the guys who are doing well also want low rates. So imagine, it's like on the Fed, the governors are the doves and the hawks. Well, the hawks have become doves, but the doves have not become hawks. So everybody is rowing in the same direction towards lower rates, lower currency, and which makes me think that this is going to last and make for a good carry trade.
That's really interesting, right? That's a perspective I didn't think about. Again, we believe that again, Germany, France are rock solid production, and the Italians and Spaniards and Greeks are just always sucking money out of the system. But now, like you said, there's this crisis at the core of the people who are actually generating the economic value there in the EU. Interesting. So let me ask you this question. Then again, as a investment advisor, I talk to my clients about emerging markets. Something happened strange to my opinion during COVID, and that is the GDP of emerging markets exceeded the GDP of G8 nations, like in 2021. And we have a demographic issue here in the United States. We have demographic issues overseas. Yet still emerging markets, Latin America especially, is still looked at as a third world country. But my view is different. I think that they could be a great powerhouse going forward. But I don't think that that consensus is shared by many Americans who are investing. They still look at the S&P 500 and the NASDAQ QQQ. AI is their thing. And they get some solace and comfort from established markets, international markets. How do you feel about most of LatAm? I mean, are you only focused on the carry trade in Brazil and Mexico, or as a firm, are you also looking across the other countries that make up Latin America and looking for other possibilities and potential there?
Absolutely. I mean, I'm actually just back from Colombia. We do a lot of business with LATAM on the commodity side at StoneX. Our largest office is actually in Brazil, even though we're New York, incorporated in New York. And yeah, we initially came into LATAM for commodities, right? Because obviously, you have iron ore, oil, meat, agriculture. I mean, you name it, right? I mean, precious metals, copper in Chile. And every country has kind of a different mix, right? I mean, for Mexico is probably the most sophisticated economy and the most integrated to the US. Mexico has a lot of oil, a lot of silver, good agricultural sector as well. Then the largest economy is Brazil, where here natural resource obviously a big thing, but the big story in Brazil has been the development of the agricultural sector. Especially not so much in the kind of hinterland, not the coast, but not the Amazon quite yet,
Mm-hmm.
where you've seen these very competitive farms and real wealth being created there. Chile is mostly about copper, right? You have Chile and Peru. Between Chile and Peru, you have 40% of the world's copper reserves there. So it's like OPEC for oil in two countries. So Argentina used to be a wealthier country in LATAM. Obviously, after decades of mismanagement, they had a lot of debt crisis, but you have very interesting things happening on the political side, which means that, yeah, I could see, I share your optimism on the continent. And when you talk about carry trades, I think one of the biggest challenges that we've had for decades now is where to get positive rate of return on cash, right? When we had QE and zero rates, central banks were telling you, well, sorry, we're gonna keep rates at zero, so your money is not getting anything. And then we had a big inflation wave, and so inflation went far above the level of interest rates, so you lost purchasing power there. Now inflation is falling, but even before it's done falling, the central bankers are cutting. So you're not going to benefit from this in the West, right? The policy is going to be, we're going to keep the level of interest rates at or below inflation. And that's just what we do because that makes it easier for us to roll our debt. Now, by contrast, look at Latam. On Wednesday, the Fed is going to meet, and the discussion is about 25 versus 50 bips. I think this is ridiculous, but that's that's what's going to happen. The Central Bank of Brazil is meeting that same week. They're going to hike rates to 11%.
Really?
11%. Yes.
Wow.
And inflation in Brazil is 5%. So you're going to get a 6% real rate. Same story in Mexico. I mean, the rate in Mexico is around 10%, inflation is around 5%. So where else do you get these very generous real rates? This is on the market.
Interesting. I think that's great. Let me ask you this question. I think you had mentioned that the national debt of France was over 100% of GDP or 115% of, like, what is it in the United States? Do you know?
Yeah, it's about in the same range. I mean, we're about a $30 trillion economy, 33 trillion, I think, US debt. It depends whether you net out what the Fed owns and the social security system, but yeah, we're on 100% of GDP in both cases.
And do you think that, again, on social media, everybody's talking about the $34 trillion debt that we have in the US? And again, it seems like we've kicked this can down the road ever since the late 1980s. Is this something that is just going to continue Raul Powell style, where the Fed is just going to keep, adding to the balance sheet, and the debt and things are their balance sheet is going to go from 9 trillion to 10 to 12 to 14, and it just never ends.
Yeah,
I mean,
yeah, I mean, I think that's correct. I mean, you keep, and I'm not, you have a lot of kind of doomer stuff on Twitter. Oh, like they're going to default on the debt, the dollar's going to lose reserve currency status, we can't afford it. I mean, I don't share that because at the end of the day, that is a problem when you borrow in a currency you cannot print, right? So why does Argentina or Venezuela or Brazil at times have issues with that? Is because they're borrowing dollars, and if they can't get the dollars, well, they can't pay the bonds, right? Well, in the US, we borrow in dollars. I mean, even in Greece, Greece could not print euros. If you borrow in euro and you're a member state, you have to ask the European Central Bank for the euro. And if the Euro Central Bank doesn't like your government, they can tell you, yeah, sorry, you won't get the euros. In the US, we borrow in our own currency. Obviously, there's a lot of use for the dollar. There's a lot of demand for dollar reserves. So I believe our capacity to carry that is actually quite high. Maybe more than 100. I mean, Japan is up to 100% of GDP, right? So we could go much higher. What it means, however, it means that our capacity to raise rates is limited, right? Because if you have 100% debt to GDP, and let's say you raise the Fed funds rate to 5.5%, like we are today. Now, not all debt reprices every day. Obviously, a lot of that is long term. But for the sake of the argument, let's assume that the yield you pay on public debt is the Fed funds rate. Suddenly, if you go from 0 to 5%, you have to spend 5% of GDP on interest payment.
Right.
Now, we said, US debt is 30 trillion, 5% of that is 1.5 trillion. That's more than Social Security. That's more than the defense budget. So what are you going to do? Are you going to suddenly cut Social Security? Of course not, right? We cut Pentagon. So that means that the ability to raise interest rates, which is something, for example, that Volcker did after the great inflation of the 70s, it could do that because the national debt was very small. So the fiscal impact of these rate hikes was very limited. In this case, so that's the idea of fiscal dominance, where your monetary policy options are constrained by the fiscal deficit. And I believe we are in this, and maybe that's what we're seeing today. This is why, at the end of the day, the Fed is going to cut by maybe 50 basis points tomorrow, is because the strain from this high interest rate in the US budget is too much. And yeah, I would much rather take a chance and hope that inflation doesn't pick up.
And do you think our markets are going to respond positively or negatively, or it just, well, you said earlier that you're more positive, that it's going to be that trampoline, and we
I
could
mean,
potentially have
the
a couple.
trampoline is on the growth side.
Mhm.
Like I think, yeah, growth is going to be okay again because we're stimulating from all sides, right? We have a very accommodative fiscal policy. Monetary policy was, I would say, neutral, and it's going to become stimulative. Financial conditions, if you look at bond spreads, junk bond spreads at 3.5, that's insanely low, insanely low. So we have this, you know, the dollar is weakening, oil prices are low, so we have all of this that's kind of boosting growth. Now, as far as asset markets go, you know, hey, the market loves the rate cut. You know, now what I will say is the market has priced an awful lot of rate cuts. So the risk is that we've already enjoyed the high, you know, like from
Right.
the
Are the
rate
rumors sell
cuts.
the news?
Exactly, exactly. And the Fed would have to deliver a lot of cuts in order to meet what the market expects. So I do believe we're going to see some disappointment there because the Fed, even though it wants to cut, will not be able to cut as much as the market wants, and that would force some repricing. I'm more concerned about the bonds because again, basically, I think we're pricing an imaginary recession. That's what's happening here. And if the recession is imaginary, then you have higher rates, which is bad for prices. But for stocks, you also means you have higher growth. You're like, oh, we're not gonna have this recession, right? So stocks may be okay because the higher rates may be absorbed by the fact that we think growth is going to be
Sure.
better. For bonds, you do not have that offsetting mechanism.
Well, that would really be interesting because it would be the opposite of what consensus is here in the US, I think. And it's a no-brainer. Like, I'm not saying it's a 100% chance that bonds are going to rally because of the recession, but I'm just saying there is a huge consensus around here, I think, from my opinion, is that you need to really rebalance, quote unquote, the portfolios where you're selling a lot of equity and buying fixed income because of the same reasons that you're talking about. We are pricing in a recession. We are afraid of the recession, and maybe bonds are not really going to do quite as well as we think if the recession is not real, right? If it
Yeah,
never really appear.
I mean, they've already done very well. I mean, just
Yeah.
look at it. Look at you know, chart of TLT. I mean, on the 10-year, we went from 5% to 3.5%.
Mm-hmm.
So that's 150 basis points. So you have this concept of duration, which is how much price changes in response to a change in yield. So typically, it's about the same as the maturity. So 10-year bond has a 10 duration of 10. So 150 basis point drop in yields lead to a 15% gain in prices. Now, these are bonds, treasuries. Like you shouldn't get 15%
Right.
return in a year with bonds, right? And bonds are supposed to be boring. So I think we've already collected a lot of these gains from these rate cuts, and the risk is that the rate cuts are not as deep as the market thinks,
Mm-hmm.
And we're not getting a lot of yields anymore. You know, like back when the 10-year was 5%, well, at least, you know, I'm getting 5% every year, right?
Sure.
Now, you know, you're just getting, you know, 3.5%. So if you even like, if you overshoot by just 2 rate cuts that don't show up, right, you
Right.
wipe out all
Yeah.
the interest you're going to earn in a year.
Right. Wow. Well, Vincent, thank you so much for spending time with us today. I really appreciate it. Is there, uh, do we have any contact information or any information that you would like to share if you want people to get hold of you and either have you on their podcast or perhaps even invest with StoneX if that's something that investors would like to contact you? How could they get a hold of you?
Well, I mean, of me personally, Twitter is the best way to do it. You can follow me on Twitter. My handle at Vincent Vincent Deluard Deluard. If you go to my pin tweet, there is a link where they can get a free trial of my reports. Just have to fill a form. I write once a week. And you can contact me by DM on Twitter. I try to monitor them. I've met a lot of very smart people who have become friends on Twitter, so I try to share the
Excellent.
love. And for StoneX, we're a very large financial service firm. We're a Fortune 100 company. If you already have an account with us, just ask your rep to get added to my list. And yeah, I mean we're really active in pretty much everything.
Sure.
I guess the focus, we have about a 40% market share on ADRs, which is American Depository Receipts, which is basically foreign stocks listed in the US. We're very big in commodities. If you want to open a futures account, we're here. Very competitive execution, stock, ETFs, options, bonds. We have great offering when it comes to emerging market bonds, and we talked a lot about LATAM. I mean, some of these markets were the biggest players. So definitely, yeah, talk to a StoneX rep, and we'd be happy to hook you up.
Excellent. I really appreciate your time, and I'm going to sign up for your newsletter because I really enjoyed this conversation, and of course the several interviews that I've watched on YouTube and LinkedIn that I am now that we're connected. So thank you, Vincent, so much for being with us, and I'll be thinking of you over the next 48 hours when we get the cuts here in the U.S.
Thanks so much. It was a pleasure.